November's wild ride ends flat, one of the weakest Novembers in 25 years. All eyes are on the Fed. Will December bring another much-desired rate cut? And setting the stage for 1Q 2026, what the markets may be pricing in already. Stay with us. It's the CB3 Financial Weekly Podcast, and it starts now. So November was a volatile month that finished barely positive. It really didn't live up to its reputation as being the strongest month of the year. We'll get more into that in just a little bit. We opened the month with a hard sell-off, concerns about stretched AI valuations, doubts about just how durable these data center CapEx might be, and lingering questions about the Fed's next move all hit at once. And for a while, it looked like we were on track for a really ugly November, but that did not play out that way. So the last week of the month, just last week, turned into a nice gain for us, even though the market was closed on Thursday and barely traded on Friday for the Thanksgiving, really 4-day weekend. So a powerful rally pulled the U.S. stock market out from the brink of disaster in November. The S&P 500 clawed its way to a tiny gain for the month. The Dow did better, up 0.3% for the month, and the NASDAQ down 1.5%. But overall, folks, it could have been much, much worse based on how we started. The NASDAQ 2000 spent most of November in the red, but ripped higher in the final week, closing almost flat to just slightly negative, despite posting its best week since 2024. Now, let's put this in context. If you line up the last 25 Novembers, this one ends up in the bottom tier for sure. November is historically the strongest month of the year for equities. You typically see solid mid-single-digit returns in bull markets and at least a decent upside in even choppy years. This year, the S&P barely finished green and the NASDAQ gave ground. Small caps needed a face-ripping rally just to get close to unchanged. So the lead story is simple. November was all drama, very little reward. One of the most volatile, modest returns in history. For trend followers like us at CB3 Financial managing your portfolios, that's an annoyance for sure. So the next question is, what's the Fed going to do in December? The market is heavily leaning toward another rate cut at the upcoming meeting. Fed officials have been trying to walk tough on inflation, but the data, where we actually have it, points to a slowing economy and labor market that is no longer running hot. Here are the key dynamics. Inflation is still above the Fed's comfort zone, but the trend is down, not up, and that's good. Growth is cooling, not collapsing, but it gives enough to the Fed to cover themselves if they want to err on the side of support. Financial conditions tightened earlier in the year, and while they have eased off from the extremes, they are still not easy for sure. What does that mean for CB3's portfolios and your money? If the Fed cuts in December and signals a willingness to cut again early, that's early in 2026, that's a positive. So long duration assets, growth stocks, quality tech, long bonds should continue to benefit. Financials will be a mixed bag because steeper curves help some banks, but lower rates pressure net interest margins over time for smaller banks. Income investors will need to be picky, and those of you trading our GI program will watch as we adjust our yield maturity to get the most bang for the buck for the income needs you have in that CB3 program. So if the Fed surprises and holds steady, you've got to expect a bunch of volatility. A no-cut outcome at the meeting when the market is positioned for a cut would likely hit high valuation names first and hardest. Defensive sectors, healthcare, staples, utilities, and real estate could outperform on a relative basis, and that would not surprise me at all if the Fed disappoints and does not cut rates. So for CB3 clients, you got to know we are not in the business of guessing one Fed meeting. We try to keep a pulse on the Fed and have an idea generally where they're going over the long run. But in the short run, Jay Powell and company are going to do whatever they think they need to do to support their mandate of low inflation and maximum employment. So we're in the business of building resilient portfolios that survive both outcomes, all right? Both outcomes, and then we use our options hedging now for all of you at Schwab, which is 97% of our book of business. and that is hedging your portfolios if there are spikes to the downside. So what do I see for first quarter 2026? What does this mean for our portfolios? Let's keep this simple and honest. Volatility, not collapse. I don't see any obvious trigger for a full-blown bear market in quarter one. What I do see is a market that has run very far, very fast. And on the AI theme, we have easing hopes, and now it's extremely sensitive to disappointment. So that doesn't mean the market is going to go down. What it means is that expectations are high, and that if any particular big company, such as Palantir or NVIDIA or even AMD, disappoints, that could trigger a short-term pullback. I don't think that means a bear market, folks. I'm not even sure it means a technical correction, which is a 10% pullback from the highs. But what it does mean is the Fed's backing away from its implied easing path. AI earnings and their guidance are showing slower adoption or return on investment, and a new geographical shock that hits risk sentiment. All of those things, or any of those things, could change the path of consistent growth in the market. But a correction is different from a structural bear market. So think 15, 10% downturn, not 40 to 50% crashes. I don't even think we're going to be 10 or 15 in the first quarter. There's just too much on the horizon. The fourth quarter earnings are so strong, which I'll talk about on my show later next week. We just don't see that at all, any kind of bear market in the first quarter. So for this bull to keep running, though, folks, leadership has to broaden. That means small caps need to participate more consistently. Cyclicals and value need to stop merely bouncing and actually start trending, which would really help us, frankly, in our GI program. And market breadth needs to stay healthy, not just on Good News Fridays. If we do get this broadening, I like the odds of the S&P pushing to new highs sometime in the first quarter or early second quarter 2026. And this is exactly what I'll be diving into on my Thursday, December 11, end of the year show on CB3 Live. So how does all this tie into our upcoming show on Thursday, December 11th? Here's the roadmap. We'll unpack November's volatility in a more detailed, more sector analysis of all the winners and the losers. 11 sectors, which ones were the winners, which ones were the losers. And what will happen with the Fed decision? How much of an impact will that have on the market, especially since the market is still adjusting to the past due news reports finally coming out? Remember, the government shut for 43 days. And during that time, there were few, if any, reports on economic progress like we're used to seeing and we talk about on the show for the last 6 years. All right. So the market is heavily leaning toward another rate cut at the upcoming meeting. Also on the show, we will walk through concrete examples of how our hedging has helped during downturns this past 2 quarters, since we've been using them now since August. And we'll also talk about multiple scenarios for a smooth soft landing and what could happen if we do have a sharper correction. So if you're a long-term investor with us, the message is simple. Stay disciplined, stay diversified, all of which we're doing for you. All right. And don't confuse noise with the actual thesis of long-term growth in our portfolios. So that's it for the update for this week. We thank you for listening. Hope you had a wonderful Thanksgiving. We're heading now into the Christmas season, which should be a fun time for all of us, I hope. Don't let the markets bring you down if December doesn't turn out exactly the way we want it. And December is generally the second or third best performing month of the year. If it finishes strong, that bodes very well. You probably know about the Santa Claus rally theory, that if we finish strong in a certain year and then we start strong in the next year, that bodes very well for the 12 months ahead, about 75% of the time. So stay with us. Mark your calendars for Thursday, December 11th for the next CB3 Live show, and we will see you soon.